to Supreme Success Academy online lecture. In my last class, the topic I discussed was the theory of cost. And in that particular topic, or let me say what the topic is all about, is that anytime a firm is established, the firm will produce goods and services. And as a result of producing these goods and services, the firm must incur some cost. That is, some amount of money must be spent in the production of those goods and services. Meanwhile, the firm will also proceed further by selling those goods produced. And remember, whenever a firm sells a particular commodity to the market, there is usually a reward. What is that reward? The reward is what we are going to discuss today. And what am I talking about? I'm talking about the reward for selling your goods and services to some consumers in the market. So, as you all know, I'm going to teach economics. And this particular topic I'm talking about is revenue concept. Revenue concept. So, in short, the reward is what is known as revenue. That is, the income that a firm generates as a result of selling its commodities or products to some consumers in the market. So, in short, revenue is the amount of money, or let me say all the income that a firm generates from the sale of goods and services, assets, and investments. So, in this particular video lecture, I'm going to move a step ahead by discussing the types of revenue, and at the same time, I'm also going to discuss economics and versus accountants. Economist versus accountant view of profit. Yes. So, as I said earlier, revenue has to do with the money income that the firm generates as a result of selling its goods and services or assets or investments to some consumers. Types of revenue. But before I discuss the types of revenue, take note of this. Profit is very important. Profit is very important in this type of situation. Profit is very important. Profit. What do you mean by profit? Profit, in the real sense, is just the difference. The difference between the total revenue and the total cost. But take note of this. Profit depends on the relationship between the total revenue and the total cost of a firm. If the total revenue is greater than the total cost, then there is profit. And if the total revenue is less than the total cost of production, then there is loss. So, the types of revenue. So I'm going to discuss just 3 types of revenue. The first one is total revenue. So total revenue has to do with the total amount of money or the total money income that a firm generates from the sale of its products. Total revenue, for instance, let's assume the price of a firm's commodity is 10 naira, and the firm at the end of the day was able to sell just 10 units to the market. So the total revenue in this situation is 100 naira. Very simple and straightforward. So the formula for calculating total revenue is, we can use average revenue. Average revenue, that is total revenue, equals to average revenue multiplied by quantity sold. Quantity sold. So what this means is that the quantity sold will determine the total revenue of a particular firm. So the second formula we can also use here. We can also say total revenue is equal to price multiplied by quantity sold. So the second type of revenue I'm going to talk about is average revenue. So average revenue is the revenue per unit of a commodity. So the formula for calculating average revenue is very simple. Average revenue is equal to total revenue divided by quantity sold. Let's just use Q to represent quantity sold. At the same time, we can also conclude that average revenue is equal to price, but not in all situations. Not in all situations. So the third one is marginal revenue. Marginal revenue. So the marginal revenue is the sale of additional units to the total revenue. That is, the revenue generated from the sale of additional units to the total revenue is marginal revenue. For instance, let's assume the selling price of a particular firm is just 10 naira and 10 quantity was sold initially. That is, the total revenue will be 100 naira. So there is increase in production from 10 units to, let me say, 11 units. 11 units. So that additional unit, let's assume the price is just 9 naira. 9 naira. So in this particular situation, we have 9 multiplied by 1, that is 9 multiplied by 1 will give us just 9 naira. So the addition of these two will give us 109 naira. 109 naira. So in this particular situation, the marginal revenue will just be equal to the initial price, which is 100 minus the new price, which is 109. Then the marginal revenue is 9 naira. So we can represent the three types of revenue in a particular diagram. Can call this revenue, can call this quantity, is X, let's call this Y, then we can have our total revenue, to be this. We can have our average revenue to be this. Then we can have our marginal revenue to be this. So this is all about the types of revenue. That is the total revenue, the average revenue, and the marginal revenue. So the next thing I will like to touch is the accountant, and I would like to differentiate between the way accountants view profit and the way economists view profit. The simple difference between the two is that the accountants only take into consideration the implicit and the explicit cost when calculating profit. Meanwhile, economists normally take into consideration both the implicit cost and the explicit cost. Let me try and explain further. When we say accountants view of profit. Remember, as I said earlier on, profit is equal to the total revenue minus total cost. So in a situation whereby we are considering the way an accountant view profit, we are going to look at a situation like this. We are going to assume that, okay, profit is equal to total revenue minus total cost. That is the difference between total revenue and total cost, taking into consideration only the explicit cost. Taking into consideration only the explicit cost. So what this means is that accountants believe that when the total revenue is greater than the total cost, when the total revenue is greater than the total cost, then there is what? There is profit. There is profit. When the total revenue is equal to total cost, is equal to total cost, this is break even. And the third one is when the total revenue is less than total cost, then there is what? There is loss. So the second one, which is economist view of profit. So remember that profit is just the difference between total revenue minus total cost. The difference between the total revenue minus total cost. And so take note of this. It usually presents itself in three ways. When the total revenue, that is profit, when the total revenue is, and so when the total revenue is greater than total cost, we conclude that there is supernormal profit. When the total revenue is equal to total cost, that is equals to 0, we conclude that there is normal profit. And the last one, when the total revenue is less than the total cost, we conclude that there is loss. There is economic loss. So ladies and gentlemen, I believe you enjoyed this aspect of revenue concept. Don't forget to like, subscribe, and share this video. Thanks.